commercial real estate, it feels like it was one of the biggest fears that never quite materialized of 2023.
It's had a little trouble, particularly with the rates going up, right? They really hit them hard, and we know how the regional banks were affected. So, Al, it's really great to have you with us to explain this all to us. As I look at it from the outside, it looks like there's not a lot of transactions going on. The measurements I've seen shows that it's actually down as a matter of total value. At the same time, there's a huge pent-up demand for refinancing. Is that an accurate portrayal, and what's going to give?
That is completely accurate, as when you have rising interest rates and a dislocation, we could debate how big this dislocation is or is going to be, but you generally have reduced transaction volume because this is a buyer's market. And so really, you don't have a tremendous number of sellers other than sort of forced by distress or duress. And so you see transaction volume down. Certainly refinancing, the desire for refinancing is massive, and liquidity constraints are very evident in the market today. And I think we could talk about the regional banking dynamic, where that seems to be sort of quiet for the moment. But I think that while it's quiet, I certainly don't think we're out of the woods from a liquidity perspective with respect to regional banks and liquidity dynamics. I personally think the soft landing was 2023, and that 2024 and 2025 are going to be the hard landing. Although I will go on to say that that's good news and bad news, because I think from a buying perspective that real estate presents the best opportunity that it's seen in the last, for over a decade, and probably for 7 to 10 years on a going forward basis.
Well, Al, you said at least two contrarian things there, of course, when it comes to the regional banks and when it comes to the soft versus hard landing. But let's start with the regional banks. You say we're not out of the woods yet. What would be the catalyst to see some more issues when it comes to that sector?
Well, I think you have the March date approaching, and so you're going to have some more liquidity constraints from regional banks. And I think that you really don't have, and there's not much debate about this, true and accurate marks within real estate portfolios. I think you've got a lot of trepidation post SVB, Signature, First Republic, in terms of, how do we progress with creating liquidity? In other words, regional banks selling loan portfolios, there is the fear of leaks or deposits disappearing, short sellers coming in, and then maybe the truth doesn't matter. You could find yourself in receivership. So I think it's a little bit of a tricky path to liquidity, but we are going to have significant real estate write-downs on the regional bank side. More than 20% of all regional bank loans have been to traditional office. Obviously, that has been an incredibly challenged sector, and one that I think is not returning probably ever to pre-pandemic dynamics. So you've got some factors where you need liquidity, where there are going to be write-downs, and for the moment we sort of seem to have fallen into the consensus is soft landing. I don't fall into that category.
So, Al, let me go to the second contrarian thing that Katie referred to, and that is this soft versus hard landing issue. What does that hard landing look like? And more specifically, is the problem, how much of the problem is really that sellers can't get their arms around the value of their property given what happened with interest rates? The fact is they're not worth as much, and they don't want to admit that and go in and do a transaction.
Well, that's always the case. We could call it the 3 stages or 9 stages of acceptance. The reality from a seller perspective is that you can't kick the can down the road any further for many sellers because liquidity is not there. Regional banks are not willing or can't extend. You've got regulatory scrutiny. And so you've got, as everybody, I shouldn't say everybody, as many know, you've got $1.5 trillion to $2 trillion of real estate debt coming due, and that is not going to be able to just be rolled out another year, 2 years, 3 years, and that will force dynamics. You will have forced velocity. Banks will have to mark more reasonably on a going forward basis, and that will create some additional liquidity dynamics. So. Am I predicting a GFC or some kind of disaster? No. Do I think the banking system is solid? Yes. But this isn't a question of putting in additional regulatory capital, whether you're at, obviously we're not at where Bear Stearns was 33 times the one leverage. We've got the best banks, 6 to 8 times, maybe maximum 10 times levered today. So we don't have that dynamic, but still at 6 to 8 or 10 times leverage, something goes wrong, and obviously things can go the wrong direction. So I think you're going to have to see a reckoning. You will see more velocity as sellers are forced to sell. And I think that presents huge opportunities, as I mentioned previously, on both the debt and equity sides of the equation in real estate. So well-capitalized players who are disciplined investors, who have, we've been running in 10-year recession cycles for the last 50 years. So those who are prepared for this current opportunity are going to be leaning in. And I think you'll see a similar dynamic to what we saw post-GFC, meaning almost anything that was bought in 2011 and 2012 from a real estate perspective turned out fantastically. I think we're in a similar dynamic right now. I'm not saying you can throw a dart and make money, but it is very much a buyer's market. And I would add to that I think that investors are starting to look for where the puck is going, not where it has been. So office and retail has taken a lot of allocations over the last 15 years. That's not where the puck is going. I think you're seeing demographically driven sectors with a lot more institutional investment interest, and that includes healthcare, real estate, student housing, data centers, logistics, and a number of other sectors.
Right.
But I would say those sectors are tremendously well positioned because you've got demand tailwinds, you got supply tailwinds in terms of constraints, and then you've got a buyer's market because of where interest rates are in the regulatory environment.
Right. Well, Al, I want to talk about how you access those opportunities, because you mentioned that there's opportunities in both debt and in equity. What situations would make more sense for an equity sort of position there versus taking one in the debt side?
Yeah, I always say it's an and, not an or. So if you agree with me that this is a fantastic time to be buying, then I think, you want to be on the equity side of the equation, and that 5 to 7 years from now. So the setup is basically this. As I said, demand drivers, Kayne Anderson specifically, what we're looking at, let's say medical office and seniors housing, are dramatically constrained new supply, double-digit rent growth in many markets that we're looking at, and sellers who don't have a significant amount of time to wait from a necessity perspective to create liquidity. So that's sort of the trifecta in terms of ability to buy at appropriate cost basis and with an outlook that that is very strong going forward. I would say, people say, well, if I can get, let's say mid-teens returns debt, mid-teens return equity, why would I do equity? And my response to that is your return on investment, or your MOIC, is going to be significantly more. That's going to be typically a 5 to 7 year hold time frame. And I think that the setup right now is as good as it's been, as I mentioned, for a significant period of time.
Al, one last quick one. What happens if, in fact, the Fed cuts sooner than people expect?
I don't see that happening, but what happens, I think the market throws a short-term party. I don't think it really has any impact on longer-term, issue. What I say from a real estate perspective is what the Fed does from this point forward, meaning how quickly they cut rates, March, May, second half of this year, how many rate cuts, what does that look like? Real estate is a long-duration asset. That doesn't really matter. I don't think we've seen the full impact from Fed rate increases that we've already experienced. So a Fed easing is going to take a significant amount of time to work its way through the system. So the buyer's market that I'm describing, the liquidity constraints that I'm talking about, are going to stay in place regardless of what the Fed does from this point forward. Mm-hmm. So I think you're looking at a very robust buying opportunity here for real estate. We're incredibly bullish on the next 2 years.
Right.
Obviously, there's a fair amount of trepidation on the investor side, and if you've got if you've got exposure to real estate, that is a tricky dynamic because you've got markdowns and pandemic related issues have been have been very different across different asset classes.